come to order. We welcome you, Chairman Powell, to the Committee for the Federal Reserve's Semi-Annual Monetary Policy Report to Congress. This hearing provides the committee an opportunity to examine the current state of the U.S. economy, the Fed's implementation of monetary policy, and its supervisory and regulatory activities. In the wake of the 2008 financial crisis, the Fed entered a period of unconventional monetary policy to support the U.S. economy, including drastically cutting interest rates and expanding its balance sheet. I've long been concerned about the Fed's quantitative easing programs and the size of its balance sheet. As economic conditions improved, the Fed began trying to normalize monetary policy, including by gradually reducing the size of its balance sheet. The Fed's balance sheet grew to approximately $4.5 trillion from around $800 billion between 2007 and 2015, and now stands at around $4 trillion still. During the press conference following the FOMC's most recent meeting, Chairman Powell provided additional clarity on the Fed's plans to normalize monetary policy, saying, "The ultimate size of our balance sheet will be driven principally by financial institutions' demand for reserves, plus a buffer, so that fluctuations in reserve demand do not require us to make frequent, sizable market interventions." Estimates of the level of reserve demand are quite uncertain, but we know that this demand in the post-crisis environment is far larger than before. High reserve holdings are an important part of the stronger liquidity position that financial institutions must now hold. The implication is that the normalization of the size of the portfolio will be completed sooner and with a larger balance sheet than in previous estimates. Banks' reserve balances grew from $43 billion in January 2008 to a peak of $2.8 trillion in 2014, before falling to $1.6 trillion as of January 2019. During this hearing, I look forward to understanding more about what factors the Fed may consider in determining what is the appropriate size of the balance sheet, what factors have affected banks' demands for reserves, including the Fed's post-crisis regulatory framework, and what amount of reserves are estimated to be necessary for the Fed to achieve its monetary policy objective. The state of the U.S. economy is a key consideration in the Fed's monetary policy decisions. The U.S. economy remains strong with robust growth and low unemployment. Despite everyone telling us prior to tax reform that annual growth would be stuck below 2% as far as the eye could see, the economy expanded, as we predicted, at an annualized rate of 3.4% in the third quarter of last year, following growth of 4.2% and 2.2% in the second and first quarters of 2018, respectively, according to the Bureau of Economic Analysis. This strong growth, which is on track to continue to exceed previous expectations, will now provide our policymakers with much greater flexibility to address other fiscal challenges than if we were continuing to struggle with insufficient growth. And according to the Bureau of Labor Statistics, the unemployment rate has remained low and steady around 4%, while the U.S. economy added 223 jobs per month on average in 2018, as well as 304,000 jobs in the first month of this year. People continue to enter the labor force, with the labor participation rate increasing to 63.2% from 62.7% over the last year. Reinforcing this strong employment environment, Fed Vice Chairman Rich Clarida said in a recent speech that the labor market remains healthy, with an unemployment rate near the lowest level recorded in 50 years, and with average monthly job gains continuing to outpace the increases needed over the longer run to provide employment for new entrants into the labor force. Major legislation passed through this committee and enacted last Congress supported economic growth and job creation. The Economic Growth, Regulatory Relief, and Consumer Protection Act passed Congress with a significant bipartisan support and was enacted to right-size regulation and redirect important resources to local communities for home buyers, individuals, and small businesses. I appreciate the work that the Fed has done so far to introduce proposals and finalize rules required by the law. Overseeing the full implementation of that law and the federal banking agency's rules to right-size regulations will continue to be a top priority of the committee in this Congress. In particular, the Fed and other banking regulators should consider whether the community bank leverage ratio should be set at 8% as opposed to the current 9%. Significantly tailor regulations for banks with between $100 billion and $250 billion in total assets, with a particular emphasis on tailoring the stress testing regime. Provide meaningful relief from the Volcker Rule for all institutions, including by revising the definition of covered funds and eliminating the proposed accounting test. And examine whether the regulations that apply to the U.S. operations of foreign banks are tailored to the risk profile of the relevant institutions, and consider the existence of home country regulations that apply on a global basis. The committee will also look for additional opportunities to support policies that foster economic growth, capital formation, and job creation. Turning for a moment to another issue, Senator Brown and I issued a press release on February 13th inviting stakeholders to submit feedback on the collection and use and protection of sensitive information by financial regulators and private companies, including third parties that share information with regulators and other private companies. Americans are rightly concerned about how their data is collected and used and how it is secured and protected. Americans need this kind of attention from this committee and from the Fed and our other financial regulators. Given the exponential growth and use of data and the corresponding data breaches, it is also worth examining how the Fair Credit Reporting Act should work in a digital economy, and whether certain data brokers and other firms serve a function similar to the original consumer reporting agencies. The Banking Committee has plans to make this a major focus in this Congress, and we encourage our stakeholders to submit their feedback by the March 15 deadline. Lastly, I want to take a moment to recognize one of our staff members who is retiring this week. Dawn Ratcliffe is the committee's chief clerk, and she will be retiring, as I said, at the end of the week. She might not want me to say this, but Dawn has been in the Senate longer than most senators. She's dedicated 27 years in these hallways and has been with the Senate Banking Committee since 2007. Starting with then Chairman Chris Dodd, and then working for Chairman Tim Johnson, then Chairman Shelby, and now myself. Dawn is a banking committee institution. She is incredibly knowledgeable, helpful, and professional, respected and well-liked by everyone with whom she works. Dawn, your work on the committee has truly made a lasting impact, and even though you will not be here following this week, you will not be forgotten anytime soon. We wish you the best of luck in your well-earned retirement. Enjoy it. Senator Brown.
Thank you, Chairman Crapo. And Ms. Ratliff, thank you again for your service to our country, to this committee, and to our country, and to the Senate. She's been instrumental in making this committee run smoothly for over a decade. We will all miss her, and congratulations on your retirement. Chairman Powell, welcome back to the committee. It's been a great week for Wall Street. The FDIC announced that banks made a record-breaking $237.7 billion in profits in 2018, almost $250 billion in profits. Corporations led by the nation's largest banks bought back a record $1 trillion in stocks last year, conveniently boosting CEO compensation. The president's tax bill put $30 billion in the bank's pockets, continues to fuel even more buybacks and CEO bonuses. But that's never enough for Wall Street. It continues to demand weaker rules so big banks can take bigger and more dangerous risks. And from the proposals the Fed has put out after the passage of S. 2155, it looks like the Fed and you are going along. The economy looks great from a corner office on Wall Street, but it doesn't look so great from a house on Main Street. Corporate profits are up. Executive compensation has exploded, all because of the productivity of American workers. But workers' wages have barely budged. Hard work simply doesn't pay off. for the people fueling this growth. 7 of the 10 fastest growing occupations don't pay enough to afford rent on a modest 1-bedroom apartment, let alone save for a down payment. Household debt continues to rise, taking its toll on families. At the end of 2018, think about this for a minute. At the end of 2018, 7 million Americans with auto loans were at least 90 days past due on their payments. 7 million Americans with auto loans were at least 90 days past due on their payments, even though the president brags about unemployment being at record lows. Borrowers of color have not recovered financially from the crisis. Too many Americans of all ages are saddled with mountains of student loan debt. The Trump shutdown revealed another frightening reality. Too many Americans still live paycheck to paycheck, even with stable jobs. After 35 days of no pay, of uncertainty, of hardships, those workers went back to their jobs and eventually received their pay. But more than 1 million government contractors weren't so lucky. We're talking in many cases about custodians and security guards and cafeteria workers making $12 to $15 an hour and going 35 days without pay and getting no compensation later, like the 800,000 government workers. We've heard a lot of talk about whether GDP will recover from the shutdown, not much about how workers will recover. I give special thanks to Senator Smith for her work on trying to remedy this incredible injustice that damn near nobody talks about. We've questioned for quite a while whether economic recovery, now in its 10th year, has been felt by all Americans. Stagnating wages, increasing income inequality between Wall Street CEOs and working Americans point to an obvious answer. Mr. Chairman, Chairman Powell, your comments at the February 6th Fed Town Hall for educators confirmed this. Teacher asked about your major concerns for the economy, and your answer was, we have some work to do more to make sure that prosperity we do achieve is widely spread. Median and lower levels of income have grown, but much more slowly. Growth at the top has been very strong. Growth at the top has been very strong. In other words, the CEOs, the folks on Wall Street, they're doing just fine in this economy. Chairman Powell, the Fed has spent a decade bending over backwards to help banks, to help big corporations that have hoarded profits for themselves, rather than investing in the millions of workers who actually make our companies successful. We're late in this economic cycle. It's clear that record Wall Street profits won't be trickling down to workers before the next downturn. Before the last crisis, we heard over and over again from government officials and banks that the economy was doing fine 10 years ago. Regulators in Congress continued to weaken rules for Wall Street, continued to ignore the warning signs as families struggled to make ends meet. As the severity of the financial crisis became clear, the Fed rushed to the aid of the biggest banks, but it didn't devote even a fraction of that firepower to helping the rest of America. Ignoring working families was a policy failure then. It's a policy failure now. Mr. Chairman, I hope we don't make the same mistake again. I look forward to your testimony and the new ideas for making hard work pay off for everyone in our economy. Thank you.
Thank you, Senator Brown. And Chairman Powell, we welcome you here again. We appreciate your attention. We appreciate the report that you have provided to us. And you may make your statement about that report and whatever information you'd like to present to us, and then we will proceed to some questions. Thank you. Chairman Powell.
Thank you and good morning. Chairman Crapo, Ranking Member Brown, and other members of the committee, I'm happy to present the Federal Reserve's semi-annual monetary policy report to the Congress. Let me start by saying that my colleagues and I strongly support the goals Congress has set for monetary policy, maximum employment and price stability. We are committed to providing transparency about the Federal Reserve's policies and programs. Congress has entrusted us with an important degree of independence so that we can pursue our mandate without concern for short-term political considerations. We appreciate that our independence brings with it the need to provide transparency so that Americans and their representatives in Congress understand our policy actions and can hold us accountable. We are always grateful for opportunities, such as today's hearing, to demonstrate the Fed's deep commitment to transparency and accountability. Today, I will review the current economic situation and outlook before turning to monetary policy. I will also describe several recent improvements to our communications practices to enhance our transparency. The economy grew at a strong pace on balance last year, and employment and inflation remain close to the Federal Reserve's statutory goals of maximum employment and stable prices, our dual mandate. Based on available data, we estimate that gross domestic product, or GDP, rose a little less than 3% last year, following a 2.5% increase in 2017. Last year's growth was led by strong gains in consumer spending and increases in business investment. Growth was supported by increases in employment and wages, optimism among households and businesses, and fiscal policy actions. In the last couple of months, some data have softened, but still point to spending gains this quarter. While the partial government shutdown created significant hardship for government employees and many others, the negative effects on the economy are expected to be fairly modest and to largely unwind over the next several months. The job market remains strong. Monthly job gains averaged 220,000 in 2018, and payrolls increased an additional 304,000 in January. The unemployment rate stood at 4% in January, a very low level by historical standards, and job openings remain abundant. Moreover, the ample availability of job opportunities appears to have encouraged some people to join the workforce, and some who otherwise might have left to remain in it. As a result, the labor force participation rate for people in their prime working years, which is to say the share of people ages 25 to 54 who are either working or actively looking for work, has continued to increase over the past year. In another welcome development, we are seeing signs of stronger wage growth. The job market gains in recent years have benefited a wide range of families and individuals. Indeed, recent wage gains have been strongest for lower-skilled workers. That said, disparities persist across various groups of workers and different parts of the country. For example, unemployment rates for African Americans and Hispanics are still well above the jobless rates for whites and Asians. Likewise, the percentage of the population with a job is noticeably lower in rural communities than in urban areas, and that gap has widened over the past decade. The February Monetary Policy Report provides additional information on employment disparities between rural and urban areas. Overall consumer price inflation, as measured by the 12-month change in the price index for personal consumption expenditures, is estimated to have been 1.7% in December, held down by recent declines in energy prices. Core PCE inflation, which excludes food and energy prices and tends to be a better indicator of future inflation, is estimated at 1.9%. At our January meeting, my colleagues and I generally expected economic activity to expand at a solid pace, albeit somewhat slower than in 2018, and the job market to remain strong. Recent declines in energy prices will likely push headline inflation further below the FOMC's longer-run goal of 2% for a time, but aside from those transitory effects, we expect that inflation will run close to 2%. While we view current economic conditions as healthy and the economic outlook as favorable, over the past few months we have seen some cross-currents and conflicting signals. Financial markets have become more volatile toward year-end, and financial conditions are now less supportive of growth than they were earlier last year. Growth has slowed in some major foreign economies, particularly China and Europe, and uncertainty is elevated around some unresolved government policy issues, including Brexit and ongoing trade negotiations. We will carefully monitor these issues as they evolve. In addition, our nation faces important longer-term challenges. For example, productivity growth, which is what drives rising real wages and living standards over the long term, has been low. Likewise, in contrast to 25 years ago, labor force participation among prime-age men and women is now lower in the United States than in most other advanced economies. Other longer-run trends, such as relatively stagnant incomes for many families and a lack of upward economic mobility among people with lower incomes, also remain important challenges. And it is widely agreed that the federal government debt is on an unsustainable path. As a nation, addressing these pressing issues could contribute greatly to the longer-run health and vitality of the U.S. economy. Over the second half of 2018, as the labor market kept strengthening and economic activity continued to expand strongly, the FOMC gradually moved interest rates towards levels that are more normal for a healthy economy. Specifically, At our September and December meetings, we decided to raise the target range for the federal funds rate by 1/4 percentage point at each, putting the current range at 2.25% to 2.5%. At our December meeting, we stressed that the extent and timing of any further rate increases would depend on incoming data and the evolving outlook. We also noted that we would be paying close attention to global economic and financial developments and assessing their implications for the outlook. In January, with inflation pressures muted, the FOMC determined that the cumulative effects of these developments, along with ongoing government policy uncertainty, warranted taking a patient approach with regard to future policy changes. Going forward, our policy decisions will continue to be data-dependent and will take into account new information as economic conditions and the outlook evolve. For guideposts on appropriate policy, the FOMC routinely looks at monetary policy rules that recommend a level for the federal funds rate based on measures of inflation and the cyclical position of the U.S. economy. The February Monetary Policy Report gives an update on monetary policy rules, and I continue to find these rules to be helpful benchmarks. But of course, no simple rule can adequately capture the full range of factors the committee must assess in conducting policy. We do, however, conduct monetary policy in a systematic manner to promote our longer-run goals of maximum employment and stable prices. As part of this approach, we strive to communicate clearly about our monetary policy decisions. We've also continued to gradually shrink the size of our balance sheet by reducing our holdings of Treasury and agency securities. The Federal Reserve's total assets declined about $310 billion since the middle of last year and currently stand at close to $4 trillion. Relative to their peak in 2014, banks' reserve balances within the Federal Reserve have declined by around $1.2 trillion, a drop of more than 40%. In light of the substantial progress we've made in reducing reserves, and after extensive deliberations, the committee decided at our January meeting to continue over the longer run to implement policy with our current operating procedure. That is, we will continue to use our administered rates to control the policy rate with an ample supply of reserves so that active management of reserves is not required. Having made this decision, the committee can now evaluate the appropriate timing and approach for the end of balance sheet runoff. I would note that we're prepared to adjust any of the details for completing balance sheet normalization in light of economic and financial developments. In the longer run, the size of the balance sheet will be determined by the demand for Federal Reserve liabilities such as currency and bank reserves. The February Monetary Policy Report describes these liabilities and reviews the factors that influence their size over the longer run. I will conclude by mentioning some further progress we have made in improving transparency. Late last year, we launched 2 new publications. The first, the Financial Stability Report, shares our assessment of the resilience of the U.S. financial system, and the second, the Supervision and Regulation Report, provides information about our activities as a bank supervisor and regulator. Last month, we began conducting press conferences after every FOMC meeting instead of every other one. This change will allow me to more fully and more frequently explain the committee's thinking. Last November, we announced a plan to conduct a comprehensive review of the strategies, tools, and communications and practices we use to pursue our congressionally assigned goals. This review will include a broad outreach to a range of stakeholders across the country, and the February Monetary Policy Report provides further discussion of these initiatives. Thank you, and I'll be happy to respond to your questions.
Thank you very much, Chairman Powell. As I mentioned in my opening statement, you said that the balance sheet normalization may end sooner with a larger balance than previously anticipated, and if I understand it correctly, the ultimate size of the balance sheet will be principally driven by financial institutions' demand for reserves plus a buffer, correct?
That is correct.
Reserves have increased from $43 billion in early 2008 to about $2.8 trillion in 2014, if I understand correctly, before falling now down to about $1.6 trillion currently. Do you have an estimate of the amount of reserves that are estimated to be necessary to achieve the Fed's monetary policy objective, and how does the Fed's post-crisis regulatory policy affect this amount?
The quantity of reserves before the financial crisis, Mr. Chairman, was $20 billion in that range, plus or minus, so a relatively small amount. One of the important things we did after the financial crisis was require banking institutions, particularly the very largest ones, to hold quite large buffers of highly liquid assets. One of those assets that the banks like to hold to satisfy those requirements is bank reserves. So the demand for reserves is going to be very substantially higher than it was before the crisis and will not go back to those lower levels in any case. We only have estimates based on market intelligence and discussions with financial institutions, and those estimates have actually gone up substantially just over the course of the last year or so. We don't have a precise notion, but we believe that the public estimates that are out there of around $1 trillion plus a buffer, as you mentioned in your remarks, is a reasonable starting point, an estimate of where we might wind up.
All right, thank you. As you know, I've been a strong critic of the quantitative easing the Fed has been engaged in, and appreciate your explanation of how you intend to reach the appropriate balance of what the Fed's balance sheet should be. And I'll continue to work with you on understanding how we get to the right spot as soon as we can. You mentioned in your statement and in your report that the labor force participation rate has started to grow. That has been one of the reasons we've seen such low economic performance, in my opinion, in the past years. Do you expect that the labor force participation rate growth that we have seen will stabilize and even possibly increase as we continue to move forward?
So labor force participation, if I can provide just a little bit of background,
Sure.
was an area where the U.S. was at least comparable to other well-off countries, and in some cases at the high end as far as women labor force participation by women was concerned. We are now at the bottom end of the league table for both men and women, and it's a very troubling concern. A big part of it, though, is driven by something that we can't really change, and that is just demographics. As the country ages, labor force participation should decline at a fairly steady level. Nonetheless, even allowing for that, we're lower than we need to be. So the gains we've seen over the past year have been very positive and very welcome from our standpoint. We don't know how long they can be sustained, but we hope for a long time. I would just say that I think we need a broad policy focus on how to sustain labor force participation, including not just through Fed policy, but through legislative policy as well.
I agree. I think that that's a critical part of our ability to maintain the growth and strength of our economy. I have lots of questions for you, but just one that I'll have time for in the remaining amount of time I have, and this will get to regulatory relief and implementation of Senate Bill 2155. As you know, Senate Bill 2155 provides smaller institutions with relief from the Volcker Rule. Regardless, there are still significant issues with the rule for institutions of all sizes, and I and 6 of my banking committee colleagues wrote to our financial regulators in October of last year, urging further revisions to the rule to address outstanding issues such as the rule's covered funds definition and its broad application to venture capital, other long-term investments, and loan creation. In addition, I'm concerned that the proposed accounting test may make the Volcker Rule more complex than is necessary. Can you commit to using your significant regulatory discretion provided by statute to promptly address these outstanding issues?
Yes, we received comments on those issues and more, and we thought some of those comments were very well taken, and we're working hard to try to address them, and I assure you we'll do our best to do that.
I appreciate that. Senator Brown.
Thank you. Thank you again for being here, Chairman Powell. Yesterday, your predecessor, Janet Yellen, said she doesn't think President Trump has a grasp of macroeconomic policy. Is she right?
I won't have any comment on that for you, Senator.
All right, I guess I'm not surprised. It's troubling that the former Fed chair, the woman that sat in your job and was very good at that job, tells the press point blank that she doesn't think the President of the United States understands the economy. I think the American people continually and more understand that this president, that many Americans, GM workers in Youngstown and Hamtramck, for example, believe he has betrayed workers in this country. That's becoming clearer and clearer. Let me shift to another question. Last week, former Fed Chair Paul Volcker raised concerns that the culture of banking only focuses on the profits of the firm and the pay of the CEO. I share this concern that we should focus on workers. Since 1979, you know these numbers, Mr. Chairman, worker productivity has grown 70%. Compensation for those workers has grown by just 11%. Meanwhile, the top 0.1% saw their earnings grow by 343%. This disparity, as you know, is even worse for women and people of color. So do you think, Mr. Chairman, the Fed's employment mandate is just to ensure that people are employed, or do you think full employment implies a dignity of work? That is, meaning workers earn a salary and benefits that let them fully participate in the 2019 economy in our country?
Our mandate, as you well know, is maximum employment, and we try to take that to heart. And our tool for trying to achieve that is monetary policy. I think, we're at a 50-year low in unemployment. There are many other issues in the country. You've managed some of them, but honestly, to achieve some of the things you're talking about, we need other tools. It's not. The Fed can't affect every social problem, as you well know.
Is that a social problem, that fewer and fewer people, even though they're employed, wages are stagnant? Is that just a social problem?
Well, wages, I would say wages do go into our assessment of maximum employment. We do look at wages, and I'm happy to say that wages, while they were very sluggish in the aftermath of the crisis, have now started to move up in a way that's more consistent with past history and with inflation and productivity.
But not even close to productivity. Not even
No.
close to gains in productivity for most workers.
So today, I know the chart you're talking about. You're talking about over the longer run. If you look at what wages are now going up a little better than 3%, inflation's right at 2%. Productivity has been running. Sorry, inflation's been at 2%. Productivity's been around 1%. So 3% is about right from that narrow standpoint. Wages have moved up. We welcome that. We don't find it troubling from an inflation standpoint at this point. So we do look very carefully at wages as we assess maximum employment, as we assess whether we're meeting our maximum employment goal.
Let me put it in a bit of historical perspective. Will Rogers, during the Great Depression, provided a lesson I think we could learn from today. He said that unlike water, money trickles up, not down. Of the government's response to that economic crisis of the Great Depression, he said, the money was all appropriated to the top in the hopes it would trickle down to the needy. Give it to the people at the bottom. The top will have it before night anyhow, but at least it will have passed through the poor fellow's hands. They saved the big banks, but the little ones went up the flue. This observation is 89 years old. It seems like the Fed still thinks, from your answer and from the behavior of the Fed, the best way to help workers is to shore up big bank profits and hope the prosperity trickles down. Over the last decade, it has been creative in how it accomplishes this. I believe the Fed has the authority and the duty to be creative, to help workers share in the prosperity they create. My staff will follow up with your staff on ways of doing that. One more question. It seems like too big to fail is alive and well. We are seeing a potential merger. We're seeing growth in most of the largest money center banks, 2 regional banks, as you know, SunTrust and BB&T, each with over $200 billion in assets, decided to merge, saying it was too difficult for them to compete with the money center banks' investment in technology. What message does the Fed send to regional and community banks about their future if the Fed eventually approves this merger?
Well, we have a process that we go through in evaluating any merger. It's set forth in great detail in the law and in our guidance. We will go through that process carefully, fairly, and thoroughly, and with a lot of transparency. When we do get an application, we don't actually have an application yet on that matter. We expect to get it sometime in the next few weeks. So we will do all of that. I would just say we haven't prejudged anything, and we're going to do our work on that professionally, carefully, fairly, and transparently.
Okay.
Senator Shelby.
Thank you. Chairman Powell, Somebody's doing something right. I don't know if it's the president or you or a combination of everything. I think this is the best economy I've seen in my lifetime at this point. Now, the question is, how do we keep it going? How do we keep it going? That's part of your job, not totally, but you're into the money. How do you gauge inflation, for example? You know, there are a lot of ways to do it. That's one. You're talking about price stability, maximum employment. Price stability, you're talking about the stability of the monetary policy, the value of our currency and everything that goes with it. How do we keep this economy going, in your judgment?
So I think you said it very well. We want to use our tools to sustain this expansion and keep the labor market strong and keep inflation near 2%. That's exactly what we're trying to do. And so we look around and what do we see? We see a labor market that is strong and continuing to strengthen. Job creation is strong. Wages are moving up. So that's a very healthy thing. With inflation, we see in muted inflation pressures. Even now with really historically low unemployment and a great recovery, an ongoing recovery in the labor markets, we still see muted inflation pressures. And that gives us the ability to be patient with monetary policy. And that's what we're going to do. The committee has decided that with our policy rate in the range of neutral, with muted inflation pressures and with some of the downside risks that we've talked about, this is a good time to be patient and watch and wait and see how the situation evolves.
How does the abundance of hydrocarbons that we have found in this country in recent years, which is prices everything, how does that feed into the economy in a positive way?
Well, in a couple of ways. One, it's a big industry. We have a very large energy industry now, thanks really to shale. In addition, if you think about that employs a lot of people, and that's a big thing in certain areas of the country. 5 or 6 major areas of the country have a lot of employment and economic activity. Interesting on inflation, if you look back to the 70s, a lot of what set off the bad inflation outcomes in the 70s was an oil shock. Mm-hmm. What we have in our very large domestic oil industry now is in effect a shock absorber, because when oil prices go up, American oil shale producers and other oil producers will produce more oil. And so that offsets that shock and will prevent that shock from driving inflation up here. So it's been a real positive for our economy from a number of perspectives.
Mr. Chairman, how important is the certainty of good trade agreements to our economy and to the world economy?
Well, uncertainty is the enemy of business. Absolutely. And businesses, they want a set of rules, they want an established, transparent set of rules, and they want to play by those rules, be able to make longer-term plans, investments, and hiring, and that kind of thing. At the same time, we need the trade. We're not responsible for trade. We don't comment on trade policy at all. But we've been hearing a lot from our contacts around the country, really all year, this year and all last year, about uncertainty, and we do sense it's been holding back some decisions, probably had some minor effect on confidence and maybe activity. But overall, certainty around trade and other government policies is very important.
As we look at our current account, the imbalance of trade with most of the world, does that concern you? And if it does, why?
The overall current account is set economically by the difference between savings and investment, in our country. So it's really an identity that kind of works that way. It tends to go up in good times when Americans are at work and earning well and buying things, and the economy is strong. We tend to buy things. Some of those things tend to be imported. The trade deficit and the current account balance can go down quickly in bad states of affairs. Of course, over time, we'd like to see balance both in savings and investment and in the trade balance.
I don't have much time left, but we've discussed this before, cost-benefit analysis. Last year, when you came before the committee, we discussed here the formation and the policy effectiveness and assessment unit to conduct cost-benefit analysis on regulations. Could you provide here an update on the work of the entity here, and what have you learned and what's going on?
Yeah, so that unit is up and running now, and it's a relatively new undertaking. Cost-benefit analysis is something we've of course done really always, and particularly in the last decade or so, we've upped our game. Now we have a particular unit focused on it. We're very pleased with the progress it's making, and they're involved in the rulemakings and assessment of everything we do. So it's a positive development, and we look forward to making it ever stronger.
My last question to you is, a few seconds I have left, is what's the health of our banking system that you regulate as with the Federal Reserve, our biggest banks?
I think our banking system overall is quite strong. Record profits, no bank failures, I think, in 2018. Much higher capital, much higher liquidity, better risk management. Stress tests have really focused banks on understanding and managing their risks. We've got better resolution planning. Overall, I think our banking system is strong and resilient. We never take it for granted. We're always looking for problems and cracks, but I would say overall our banking system is strong.
Thank you. Thank you, Mr. Chairman.
Senator Menendez.
Welcome, Chairman. As the number of legitimate cannabis-related businesses grow across the United States, the vast majority of banks and credit unions are not offering services to these enterprises for legitimate fear of legal and regulatory risk. My home state of New Jersey is moving towards legalization of recreational marijuana, and I have concerns that these new businesses, as well as the existing medical marijuana businesses in the state, will continue to find themselves shut out of the banking system. And when these businesses are forced to operate exclusively in cash, they create serious public safety risks in our communities. Do you agree that financial institutions need clarity on this issue?
I think it would be great to have clarity. Of course, financial institutions and their regulators and supervisors are in a very difficult position here, with marijuana being illegal under federal law and legal under a growing number of state laws. It puts financial institutions in a very difficult place and puts the supervisors in a difficult place too. It would be nice to have clarity on that supervisory relationship.
And in a corollary question, related to the provision of banking services is the ability for such businesses to secure insurance products, a necessity for those looking to secure financing. Would it be helpful for Congress to also consider the role of insurance companies as states move forward towards legalization?
I believe so, yes.
Okay. On a different question, February 7th, BB&T announced that it planned to purchase SunTrust in a deal that would result in the combined bank becoming the 6th largest commercial bank in the country with $434 billion in total assets. As you may know, in 2008, BB&T's Community Reinvestment Act rating was downgraded due to substantive violations of the Equal Credit Opportunity Act and the Fair Housing Act. BB&T's most recent CRA exam, released last year, also included a substantive violation of fair lending laws, a violation which likely should have resulted in another downgrade to the bank's CRA rating. I want to be sure that the Federal Reserve is not following the OCC and de-emphasizing its treatment of fair lending violations when it comes time to evaluate a proposed merger. What assurance can you give us that the Federal Reserve will treat these violations with the seriousness they deserve?
We haven't changed our policy on that, and we do consider it comes in under in the law under convenience and needs of the community served, and that includes consumer compliance and fair lending records, and the record of performance under CRA. Those are all things that we do consider in when we get a merger application.
And when you're considering it, can you give us a sense of what the Federal Reserve's review of this bank or any other bank's Community Reinvestment Act track record and compliance with fair lending laws will look like?
We'll look, we'll look thoroughly at it. We'll look at the rating, of course, which I believe I think it's satisfactory now. Banks that have an unsatisfactory or less than satisfactory rating, I think, have a hard time. But we'll look at that, and we'll also consider public comments and a full range of information. Any information that's presented to us, we'll consider.
Well, I ask this question because it seems to me that, particularly at the OCC, who has released a proposal without input from the Fed or FDIC, contemplating sweeping changes to the implementation of the Community Reinvestment Act. In a speech last year, Governor Brainerd said the Community Reinvestment Act was, quote, more important than ever. She stressed that branches and deposit-taking ATMs remain an important way that banks engage with the community. You also highlighted recently the importance of enforcing the CRA and other laws that help ensure people have adequate access to financial services wherever they live. Can we get your commitment to build consensus among the Fed governors before moving forward with proposals to change implementation of the Community Reinvestment Act?
Oh, yes.
Okay. I think it's important that you do everything in your power to try to achieve a unanimous vote on this issue should the Fed decide to move forward. Many of us find this an incredibly important part of our law and an increasingly diminishing reality of financial institutions that somehow think that they do not really have to fully engage and implement the law and ultimately still get away with it. And so I think there has to be a strong message that that's not the case. I hope you'll be able to deliver that message.
We are unified in our commitment to, to the mission of CRA, and to any revisions that we do, we're going to want to see that they preserve that mission and enable banks to serve it more effectively.
Thank you, Mr. Chairman.
Senator Toomey.
Thank you, Mr. Chairman. Chairman Powell, welcome back. Good to see you again. Let me just start by once again complimenting you and your colleagues on taking us a long way towards normalizing monetary policy. In my view, this was long overdue, but you have been pursuing what strikes me as a prudent, thoughtful, and data-informed process of getting back to normal. So I want to thank you for that. Quick regulatory question, if I could. I was pleased with the interagency proposal that was released by the Fed and the other agencies dealing with 2155 and specifically the tailoring of capital and liquidity requirements, enhanced prudential standards. I think the comment period closed in January on this proposal. Can you assure us that it's a high priority to finalize these rules?
It's a very high priority. 2155 implementation is probably our highest priority, and we're pushing ahead.
Any idea of a time frame by which we could expect to see a finalized rules there?
I wouldn't want to put a date on. I mean, there's so many rules. There are a dozen rules where we have comments on right now. I can come back to you with
okay, but I'm glad to hear it's a priority. We're obviously eager, and we think I think you're heading in the right direction. Unrelated, as you know, the private sector has set up a real-time payment system, and I think a real-time payment system is a terrific innovation that's very, very good for our economy. My understanding is all depository institutions have access to it on an equal footing, as they should. To the extent that that's the case, do you believe it's necessary for the Fed to develop a alternative or competing real-time payment system?
That's a judgment that we haven't made, that we sought comment on that question, and we've had a range of views, and it's something we're thinking about. We are mindful that we don't, under the Monetary Control Act, for example, we have to find that the services we provide are capable of being paid for, and also not something that the private sector can adequately provide. So
right.
We're looking at that very question.
I'd be interested in just hearing what your thoughts are as you go forward on that. It does seem to me that the private sector is providing a perfectly viable and affordable and reasonable mechanism here. On another topic, as you know, there's been recent discussions, both I think inside and certainly outside the Fed, about whether the Fed ought to reconsider the way it thinks about inflation. And specifically, I guess the way I understand this discussion is whether the Fed ought to target a price level rather than a change in the price level. And specifically, if there were an extended period of time when inflation ran below a target, would it make sense for the Fed to intentionally attempt to exceed the target modestly or by enough so that over a long period of time you'd hit the average? My first reaction is to be pretty concerned about that. Intentionally running at an inflation rate above the target rate worries me, given that historically inflation has been much harder to control, and high inflation has been a bigger problem than low inflation. But I wonder what your thoughts are about this topic.
These are questions, as you know, that are going to be the subject of careful consideration over the course of this year and beyond in our thinking. You know, the issue that we face is that rates have come down, long and short rates have come down really over the last 40 years and are now they're just much lower. Real rates, and of course inflation, add inflation back in, nominal rates as well. The implication of that being that in a typical downturn, the odds are much higher that we'll wind up back at the zero lower bound again. So in that situation, that fact there has the potential to drag inflation expectations down over time. In our thinking, inflation expectations are now the most important driver of actual inflation. So we're trying to think, and really the economics profession has been thinking about it for 20 years, since the experience of Japan in the late 90s, thinking of ways to make that inflation 2% target credible, highly credible, so that inflation kind of averages around 2% rather than only averaging 2% in good times and then averaging way less than that in bad times, which would drag expectations down. No decisions have been made. It is, you raise there are plenty of questions and concerns to be addressed, but there's also a problem that I think we owe it to the public to try to think our way through the best possible way to address that problem so that we can carry out our mandate.
Yeah, I understand the logic. I understand the problem that you're wrestling with. I would just urge great caution on this for many, many reasons, not the least of which, for whatever period of time the Fed decided it would exceed the goal so that it averages the goal. First of all, during that period of time, presumably you don't have price stability. I mean, certainly not zero. I mean, you know, you'd be intentionally running above even the goal. So I've got other questions, but I see I'm out of time. I just want to urge caution on that one, Mr. Chairman.
Senator Tester.
Thank you, Mr. Chairman. Ranking Member Brown, thank you for being here. Chairman Powell, I appreciate your service, appreciate the work you're doing. I want to talk a little bit about the government shutdown that we just came through, cost the economy $11 billion. I think that's a conservative figure. There's at least one in this government that wants to use government services and public employees as a pawn when they don't get their way. But what I want to ask you about is that we are faced with a debt ceiling coming up March 1. Could you walk us through quickly, if you could, the economic impacts of failing to increase that debt ceiling?
Well, the failure to increase the debt ceiling creates a lot of uncertainty in the first instance, and then when you actually get up to the point where the government runs out of cash and doesn't pay its bill, we've never passed that point yet. That's kind of a bright line, and I hope we never do pass it. But there's a lot of uncertainty that's generated and a lot of distraction from what is otherwise a pretty good economy.
What would happen to our interest rates on $22 trillion worth of debt if we were not to do what we needed to do with the debt ceiling?
It's beyond even considering. The idea that the United States would not honor all of its obligations and pay them when due is just something that can't even be
Would it double?
considered. It would go up. I mean, but I think we have the best credit rating. We borrow at very low rates, and the world believes in our full faith and credit. And I think that's not something I would.
It would have draconian effects on our economy overall.
Potentially, very hard to predict and possibly large.
But there's some
effects.
that in this body, quite frankly, that say it'd be no big deal. Do you agree with that?
No, I don't. I think it'd be a very big deal to not to pay all of our bills when and as due. I think that's something the U.S. government should always do.
I agree. Senator Shelby talked about the certainty of trade agreements. I won't ask you to grade this administration's trade policies, but from your are also suggesting, and the small businesses are telling me that the big guys can afford to stay in business because of these trade wars, but they're going to be out of business. And we're not talking about family farms now, which is absolutely affecting my previous question. But do you believe that the trade policies impact smaller businesses greater than the big ones?
I don't know the answer to that.
I've got a series of questions that I think I'm just going to put them in as questions for the record and ask you to respond later on. Very seldom do we get an opportunity to have the chairman of the Fed come in front of literally the country and to share his thoughts about the direction of our country. In many cases, the clearly that debt is being financed. That means there's competition for those dollars. The Federal Reserve, on the other hand, it actually manages through regular meetings and discussions run significant deficits. Would you care to comment on the way that Congress manages or does not manage the safety net? As perhaps, for lack of a better term, one of the chief economists in the nation, to be able to give advice to the folks that are out there, to the country as a whole.
The other day, and I want to follow up a little bit on what Senator Tester was asking about regarding the economic issues in rural areas. So, and I appreciate older and
Or perhaps less able to find a job.
that are there aren't paying. So how come wages don't go up? If there's a demand for labor, people potentially are there. Why don't wages go up?
So I think, as I mentioned earlier, wages have moved up from their very low levels of increase earlier. Their benefits with their first dollar of earnings, which
Thank you, Mr. Chair.
Senator McSally.
Thank you, Mr. Chairman. Chairman Powell, good to see you again. I want to continue actually on the line of discussion that you've been on. In our conversation when we met, we
substantially lower, but they are, or they're staying in. So labor force participation is rising. You know, people have been leaving for some time. Some of these counties, as you obviously know, have lost half their population in the last 4 or 5 decades.
If states, individually, if the states were developed access to health care, what would you expect the economic impact to be?
Well, I think people who, health care is going to, you know, in principle, would allow people to remain in the labor market, would get them back in the labor market, and keep them from getting sick and being out of the labor market. Part of the job is to ask that question,
All right.
which I was.
Thank you, Mr. Chairman. Appreciate you being here. Thank you, Mr. Chairman.
Senator Kennedy.
Mr. Chairman, thank you for coming today. My good friend Senator Brown lamented the fact
We need a profitable financial system to have a well-capitalized financial system.
well, is it better if banks are making money or losing money from a macroeconomic standpoint?
I think we want banks to be profitable and strong and well-capitalized, and they have been.
Okay. I want to talk about the government shutdown. Tell me if I get this wrong. CBO estimates an $11 billion impact to our economy. We'll recover about $8 billion, so encourage more business investment in plants and machinery and equipment and software, which would have created more jobs and hopefully increased productivity. Specifically, let me ask you this. There's legislation to prohibit share back
Private hands.
right?
And I would want to understand the consequences of
how many of those 3,819 applications you denied?
No, I don't.
Would 0 sound right?
Statutory problem. You know, they're for example,
Okay.
in some
but
cases.
you approve 100% of those that go ahead and apply. So I assume they're getting
unless they're
some
withdrawn.
news.
Unless they're
That's what I
withdrawn.
said. So you encourage them to withdraw if they're not going to get an approval.
What they can file and then withdraw.
Well, but the point is they withdraw if they're not going to get it because of a conversation you have that's a non-public conversation. So
We're in the process of looking at and revising and I would think addressing that issue.
Okay, but to be perfectly clear, banks between $10 billion profits to businesses, whether they're the biggest corporations or small businesses, have gone from 12% to up to 20%. Can you give me your thoughts on why we're seeing more income going into the hands of owners in this country and less in the hands of workers?
Yeah, so
encouraging.
I think what you hear from builders is labor shortages, particularly skilled labor shortages, and you also hear higher materials costs, some of which affected by tariffs, of course. But that's what so you hear them under tremendous cost pressure, and I think that was flowing through into higher prices, and that was it's just research, and I think there's a growing amount of research that shows that student loans, of course, have been growing very, very fast in the last few years. And
Was that the right number, the 400,000?
Well, I appreciate that. I would want you to do that. But if the recent interagency proposal for community bank leverage ratio allows certain banks with less than $10 billion in total assets to elect to use the CBLR instead of the current risk-based capital requirements. If this
Senator, can I ask, is that a comment that you have
if we and I visited about last time we talked is in significant faces significant challenges. I want to make certain that our
Thank you, Mr. Chairman. Real wages, and isn't it the case that when you look at real wages and the rise in real wages during the last term of the Obama administration, real wages rose faster during that period to discharge their debts in bankruptcy, just like banks can?
So can be quite a negative.
Well, it's a lot of people who can't. Late fees and payday loan interest rates
as a result of
They include climate change in our supervision, but we do actually require financial institutions, particularly those who are more in place, to deal with that sorts of things. So you would pick up natural disasters and that kind of thing, which are associated with climate change.
Do you think your processes and over the last 2 or 3 years?
And in fact, we're looking at very draconian numbers in terms of the situation at the BCA. But do you that going out and making sure that's community bank?
Comment by some of the senator, or one of the senators at least, that
we've had, if labor force participation had not gone up, then the unemployment rate would. The aging of the population is decreasing labor force participation at a trend rate, and that trend rate is about 0.2 or maybe 0.25 or issue, and I think those are the people we want to get back.
All right, thank you. And just to switch topics for a minute, we've seen, I think you indicated a little bit under 3% growth in our GDP in the last year. I guess on Thursday we're going to get some economic analysis that'll give us some statistics on that. One of my colleagues indicated today that with regard to the tax bill that was passed, there was a lot said, and this, I'm not going to ask you to comment on this, I'm just putting some facts out there. There was a lot said about how the tax bill would generate a $1.4 trillion deficit. That projection assumed somewhere in the neighborhood of 1.9 or 2% growth in the economy. It was indicated at the time from all of the analysis we got that if we just had 0.4% rate of growth above that, there would not be any deficit involved with the tax legislation. And of course, we've seen far more than 0.4 of a growth so far in terms of the performance of the economy. So that leads to my question, and I know that you don't have a crystal ball, but you do analyze what it looks like for the economy. And my question relates to, given what we've seen a growth of about almost a percentage point in the GDP over the last 12 months, over previous growth rates, if I understand it right. Do you have a projection, or do you have anything that you can share with us about what you see moving forward as to whether the economy will continue to perform? I know you said that it may slow down a little bit this year, but do you have a projection as to what it would likely look like over the next few years in terms of GDP growth?
No, I think you can. I think the good place to start with that question is what makes up growth, and it really boils down to more hours worked, and then more output per hour. That's really all there is. And more hours worked is really a function of population growth. Population growth has slowed, or let's say it this way: the trend growth in the labor force, given aging and given immigration and everything we have, is only about 0.5 right now. And actually, if immigration is going to be even lower, then it's going to be below 0.5. Immigration has made up, half of that 0.5. So that's one piece of it, is 0.5% trend labor force growth. The rest is just productivity. No one can forecast productivity growth with any confidence. All we can really do is create policies that will, encourage investment, encourage innovation, and all those sorts of things, and let productivity happen as it will. It's something that just happens. But if you look at longer-term averages, it's been very difficult to predict. But you'd have to have sustained high productivity. If you're going to have 0.5 labor force growth, you'd have to have, very high sustained productivity, higher than we've seen, frankly, to get, really high levels of growth. But that's why I think it's so important to focus on both of those two things: labor force participation and also productivity. That's the closest in thing we can focus on to raise our potential growth rate.
Well, thank you. And in terms of increasing labor force participation, I know there are a lot of factors. One that's been brought up here today already is to perhaps change our policy at the policy level so that a person who takes a job who's not currently employed, a person who's willing to go take one of those jobs and become productive in the labor force does not actually economically suffer from that decision based on the safety net program support that the government is already providing. I'm not going to ask you to comment on policy, but is it correct that if we were to eliminate or reduce the incentive to stay unemployed because of the disadvantage of economically of relying on wages rather than benefits, would increase labor force participation?
I mean, I think incentives do matter, and I think I would think if you go back to work, your pay should only go up. In my perfect world thinking, again, easy for me to say, but that's how I would say it.
All right, thank you. Well, switching gears one more time, and then I'll wrap it up. Housing finance reform. As I'm sure you've seen, there's a very significantly increased emphasis on housing finance reform, both on this committee and I think in Congress in general, as well as at the level of the administration. In 2017, you gave a speech in which you outlined a few principles that you saw for how we should approach housing finance reform, and I'm just going to quote what you said: "Do whatever we can to make the possibility of future housing bailouts as remote as possible, to change the system to attract large amounts of private capital, and that any guarantee should be explicit and transparent and should apply to securities, not to institutions, and to identify and build upon areas of bipartisan agreement." Do you still agree with those principles and how to approach it?
I sure do.
Well, good. I agree with them too, strongly. And we are going to be very aggressively trying to put together a bipartisan solution to this here on this committee and in Congress in general. And I just would like to ask you, first of all, if you'll commit to work with this committee in our efforts to build the right solution to this issue. And then secondly, any other comments you might want to make about how our nation should approach housing finance reform. And I'd ask you also to discuss how getting this fixed could impact our economy and could impact growth.
Yeah, so I do think, and I said this in those remarks, that I think that this is one of the big unfinished pieces of business in kind of the post-crisis reform period. Fannie and Freddie had to be taken over by the government fairly early on in the financial crisis. It was a big part of the financial crisis. And I think the proposals that you've had in the past, and I'm sure the one that you'll have this year, I think they all have the right elements there. It's just a question of getting something done, and I think it would be really good for the economy and to get this off the federal government's balance sheet and get a lot of private capital between the taxpayer and the housing risk, if you will. So I think it'd be a very positive thing for the economy, and of course we'll be delighted to work with you. We have, I think we have some very strong, experienced staffers in the housing area, and we'd be happy to provide whatever expert help we can.
All right, thank you. And I know I said that was the last one, but this is really the last one. Again, shifting subjects. You've testified today that there are some pretty positive things going on in our economy right now, and that we're in a relatively good position on a lot of factors. In terms of risks to our economy, could you just tell me what you think are some of the bigger risks we should keep in mind?
Again, I do think that the baseline outlook is a good one, favorable one. There are always risks, though, and as I mentioned, I do see the foreign risks as particularly relevant right now. So global growth has slowed. It's slowed in China. It's slowed particularly in the advanced economies, and particularly in Europe. When growth is booming around the world, we feel that as a tailwind. When growth is slowing, we feel it as a headwind. And I think we're feeling some of that now, and we may feel more of it. So that's a risk. Brexit is an event risk, which should not, in the end, have much of an effect on our economy, but it's something we're monitoring very carefully. Domestically, I think we're in good shape. Unemployment is low. Confidence is still at positive levels. So I feel like we have the makings of a good outlook, and as I said, our committee is really monitoring the cross currents, we call them, which are really the risks. And for now, we're going to be patient with our policy and allow things to take time to clarify.
All right. Well, thank you. And I know I speak on behalf of the committee. We appreciate the dedication of you and the other governors at the Federal Reserve. We all want to have this economy stay strong and grow stronger. And we look forward to making sure that we can achieve the right policies and help together to make that happen. My last closing comment would be I echo the concerns, or not the concerns really, but the issues raised by some of my colleagues about the implementation of 2155. I know you're working I know you just said it was the highest priority maybe at the Fed right now on the oversight level, but I just encourage you to move ahead expeditiously on those issues. A number have been raised already. I'll reiterate, our concern that we move as quickly as we can on the implementation of the requirements and the principles of 2155 with regard to those financial facilities, banks under $100 billion, and getting the stress testing levels for them at the right point. If you want to comment on that, you're welcome to. If not, I'll wrap up the hearing.
I might add one thing to my last comment, if I could.
Sure.
I would want to leave you with the thought that when I say we're going to be patient, what that really means is that we're in no rush to make a judgment about changes in policy. We're going to be patient. We're going to allow the situation to evolve, and also the balance of risks, and allow the data to come in. And I think we're in a very good place to do that.
All right, thank you. I appreciate that perspective. And once again, thank you for being here with us today. That does conclude the questioning for today's hearing. And for senators who wish to submit questions for the record, those questions are due on March 5th, Tuesday. Chairman Powell, we ask that you respond to those questions as promptly as you can. Once again, thank you for being here, and this hearing is adjourned.
Thank you, Senator.